When a company buys back its own stock, a process known as a share buyback or stock repurchase, it is essentially becoming a buyer of its own shares in the open market or through a tender offer. And while this may sound unusual at first, it is a common corporate action used by companies to manage capital, influence shareholder value, and signal confidence in their business. At the most basic level, a buyback reduces the number of shares outstanding, which means the company's earnings are spread across fewer shares, often increasing earnings per share, or even if total profits remain the same. This mathematical effect alone can make the stock appear more attractive to investors and can contribute to a higher share price, particularly in markets where EPS growth is closely watched. From a strategic perspective, companies often choose buybacks when they believe their stock is undervalued, effectively investing in themselves rather than pursuing acquisitions or paying dividends. Reinforcing Warren Buffett's view that whether we're talking about stocks or stocks, I like buying quality merchandise when it is marked down. Buybacks also provide flexibility compared to dividends, because while cutting a dividend can send a negative signal to the market, buybacks can be increased, reduced, or paused without the same reputational damage, allowing management to adapt capital allocation to changing conditions. For shareholders, buybacks can be beneficial in several ways, as they increase ownership percentage without requiring investors to purchase additional shares, meaning each remaining shareholder owns a slightly larger piece of the company after the repurchase. In addition, buybacks can support share prices during market downturns by providing consistent demand, which may reduce volatility and signal management's confidence in the company's long-term prospects. However, buybacks are not always a positive sign, and context matters greatly, because companies sometimes fund repurchases through debt, increasing leverage and financial risk, particularly if borrowing costs rise or earnings decline. Critics also argue that excessive buybacks can divert funds away from productive investment, research, employee development, or long-term growth, prioritizing short-term share price support over sustainable value creation. The timing of buybacks is another important consideration, as companies often repurchase shares during market highs rather than lows, meaning they may overpay for their own stock, which can destroy shareholder value instead of creating it. From a market perspective, buybacks can influence supply and demand dynamics, as reducing the number of available shares can contribute to price appreciation, especially when combined with strong fundamentals and investor demand. There are also tax considerations, as buybacks can be more tax-efficient than dividends in certain jurisdictions, allowing shareholders to realize gains through capital appreciation rather than taxable income. However, regulators increasingly scrutinize buyback programs, particularly when companies engage in repurchases while simultaneously cutting jobs or underinvesting in their businesses, raising questions about corporate priorities and long-term economic impact. As Benjamin Graham warned, operations for profit should be based not on optimism but on arithmetic, and investors must look beyond headline announcements to assess whether a buyback is truly valuable. Ultimately, when a company buys back its own stock, it is making a statement about how it views its valuation, capital needs, and growth opportunities. And while buybacks can be a powerful tool for rewarding shareholders and optimizing capital structure, they are most effective when